All right, guys, so today we are talking equity, and equity in a property refers to your ownership interest that you hold in a property, and it's basically the difference between the property's current market value minus any mortgages or any loans that you have against that property. And it's essentially really the portion of the property that you actually own free and clear, right? So it's really simple. So equity is our ARV, right, minus any mortgage. And I'll put mortgages in case like you have two lines of credit, or maybe you got a line of credit and a single mortgage. Yeah, so whatever the mortgages balance are. So going after our property that we just bought, our $1 million property, ARV is $1,080,000. Now let's say we didn't pay off any principal on this. We're gonna say that our loan balance on this property is about $800,000. So our equity equals $280,000. As you can see, this does take into consideration any down payment that you would have initially made on the property. Now, let's say we're able to go and get a line of credit for $100,000, and we used it. Then it's going to go $100,000 plus $800,000 is $900,000, and then that's going to give us $180,000, right? So as you can see, that's how equity works. It's essentially a loan balance minus the ARV, and that's going to give you what you could add actually to your net worth. I'll see you guys on the next one.